Hello, everyone, and welcome to this webcast. My name is Mira Rahman, and I'm the retirement and financial planning reporter with the Globe and Mail. And we are so pleased to have you today, and I am pleased to be your host and moderator. Before we get started, I would like to acknowledge that the land on which the Globe and Mail headquarters is situated is the traditional territory of the Wendat, the Anishinaabe, the Haudenosaunee, the Métis Nation, and the Mississaugas of the Credit First Nation. We are grateful to have the opportunity to work and live on this land and continue reflecting on that. So, we are really excited to bring this event to all of you today. Over the next hour, we will be discussing how new investors can start building their financial future. In my work at the Globe and Mail as a reporter, I spend a lot of time speaking with young people about how they can set themselves up for success and with experts about the best tools to do just that. So, I'm really excited to dive into these topics with our panelists today. And today's event is presented with support from TD Bank. We are pleased to have a representative from TD Bank on our panel today, along with other speakers who are sharing their views independently. So just a heads up as well, as we go along, you can type in any questions that you want answered by our panelists in the Q&A box that will pop up on your screen, and we will get to as many as we can a little bit later on. But before diving into all that, we have to introduce our wonderful panelists who are here with us today. So first off, we have Hareen Amin, who is a Trading Insights host at TD Direct Investing. Welcome, Hareen. Thank you so much. We also have Ben Felix, who is Chief Investment Officer and a Portfolio Manager at PWL Capital. And finally, we have Shannon Lee Simmons, a financial planner and founder of the New School of Finance. Welcome, everyone. Thank you so much for being here, sharing your insights. I know that we all have a lot to learn from you all and not that much time. So let's jump right into these discussion points. So I know something a lot of us were talking about, prior to this call in our pre-meetings was just that hesitation to start investing and jumping in. A lot of people want to invest, but they don't know where to start. So I would love to hear from all of you to kick off our panel today. From your perspective, what do you think are the biggest barriers holding new investors back today? Hareen, why don't we start with you?
Yeah, thanks for having me, Mira, again, and welcome to everyone. When you think about some of the data that we pulled just recently, there's a study by Wealthify done. 66% of first-time investors thought that just the thought of investing makes them nervous. Then you have 70% that says it's a lack of knowledge. So it's really a combination of not so much the market, but the mindset. I don't know enough, or I'll lose it all. And so those are the psychological barriers that are going to, act as those barriers that before investors can even get into the market. So it's just overcoming that. But when you think about just the knowledge piece alone, that if you think about it, it's a bridgeable gap. You don't need to understand every instrument. Sometimes you just need to understand one thing to get you started. And this is an old adage that will be spoken about throughout, I'm sure, today in today's conversation, and that is time in the market beats timing the market. So it's just a combination of, again, just understanding I don't know enough, or I feel nervous, or I'll lose it all. And I think some of those ways we can talk about how you can even overcome them.
Thank you so much. Ben, Shannon, any thoughts on this?
Yeah, I agree with what Hiran said. I think that a big issue that a lot of investors face is pessimism, and investing inherently requires optimism. So that financial literacy piece is huge just to get started, but also having optimism that financial markets are going to continue to deliver positive returns as they have for a very, very long time is a huge piece of being a successful long-term investor.
And I would just add, I think that those are the two fundamental problems, but I think they're exacerbated as well by today's uncertainty and the news cycle and everything that you hear. Can't really escape it. And then in addition to that, it's sort of there's so much information and content out there in the world about investing and how to get started. There's sort of a okay, who do I trust and which philosophy should I choose? And not really knowing who to trust for what information. So it's the same problem. Just I feel like today's new investors are up against a lot. I think it's an intimidating place compared to even like 10 years ago.
I'm so glad you brought that up, all of you, because we're going to get into all of these, subtopics in our conversation today. But I just think it's so interesting that a lot of what's in the way for new investors isn't actually, the numbers or the spreadsheets. It is these psychological barriers, and I think that is really important to remember. And I want to get into a little bit about how people can start thinking about investing when what they're thinking about mostly at this point probably is paying for the everyday costs that they have. Investing can easily fall down a priority list, especially for young people who may be dealing with lower or irregular incomes, juggling rent, student loans. So, how can people balance starting to invest while also keeping up with their everyday costs?
Oh, I'd love to just jump in right there. I think that you need to make sure that you have your everyday costs covered first before, and maybe that's controversial, but if you are going into credit card debt in the name of a RRSP contribution at the age of 22, like I think that that's a priority issue. And so I do think there's a lot of pressure to invest right now and make money fast. And which is not the way to, that's not an investment philosophy, but I do see that playing out sometimes. So I would say once you, like my priority for anyone, and this doesn't mean just new investors, this is for everybody, is, if you're looking at your finances, making sure that you've got enough for a rainy day, making sure that consumer debt is managed and manageable on a plan, and then we start investing in like RRSPs and TFSAs and stuff. So if those first two pieces are covered, then by all means go to invest. And I think the balance is, we all want to say a little bit goes a long way, and it does. And I think emotionally and psychologically, it feels better to build a future by seeing savings than to pay off debt, which is like a financial hangover that we have to deal with. But your net worth is increasing by the same amount, whether you put $100 on a line of credit or you put $100 into a TFSA. One just feels astronomically better. And so I just think that the balance is both psychological and financial, because the credit card debt and the consumer debt is going to be a high interest rate, and sometimes the emotional hangover from that is also can lead to like a negative relationship with money. My 2 cents.
Yeah, and I'll add to what Shannon said. I think when when you're tackling all these sort of, life as a whole, things do catch up on you. And sometimes if you're saying, hey, I'm just going to invest later, or this is not the right time, you're just kicking the can down the road eventually. So you really got to commit to yourself to say, this is something that I really want for my future self. I'm investing in my future self over here, and I want to create a plan to do it. A budget is a big piece of that equation. When you, as Shannon mentioned, you want to have that rainy day emergency fund. That's going to act as your financial shock absorber for anything that could happen, really. Maybe call it 3 or 6 months. Some even go as far as a year saving up. But also don't ignore debt. You might say that I can go into the investing market and chase, 10, 12% returns. But at the same time, if you have high interest rate debt, we're talking about north of 20%. That's as good as wiping out any investments you're doing with that sort of debt. So, to emphasize what Shannon said is really focusing, especially if you have high interest rate debt, to pay that down as much as you can, and then really get into your investing groove of it. And then automating is one thing that you don't want to forget, because you could say, like, I'm going to transfer X amount of dollars, or I'll put in, certain amount of dollars on my own will and choosing. But once you automate it, it's so much easier. Just pay yourself first. When you get the money, allocate whatever that be. Most traditional budget will say you want to save about 20%, maybe 15% towards your long-term investing, 10% to your short-term investing, and just automate it and have it go away, so you're not having to worry about spending it on something maybe frivolous there.
I'm going to share what might be a bit of a controversial opinion. I mentioned this in one of my videos recently, and did get a lot of interesting feedback. It really split the comments in terms of whether they thought I was crazy or totally agreed. The opinion is that one of the best ways to reduce financial pressure and improve your financial position, I agree with everything that's been said so far, but one of the best ways to accomplish this is to increase your income. Now, it's controversial because people say, well, no, I can't just, of course, if I would increase my income if I could. I mean, cutting unnecessary expenses, budgeting, that is great. It's valuable, and you should do it, but it only goes so far. Increasing your income through education, certifications, professional experience, that is huge. And it can go a lot further than cutting expenses and and budgeting. So I know it's controversial because people don't always feel like they are able to do that to increase their income. But if it is possible, if there are ways that you can do that, it is one of the most valuable things that you can do for your financial situation.
But I don't think it's controversial at all. In fact,
No.
like when you talk about it, when for someone to start out, you're absolutely right. You got to have side hustles or multiple sources of income, especially when you're starting out of the gates. Because, to think about getting to your first 10,000 investment or even the 100,000 is a big milestone before, compounding really works in your favor. A lot of that weight is based on your savings, how much you can put into that to get to those milestones. And it's not going to be just, investing, at 7% over 10 years to get there. You do have to have some aggressive savings, and it's going to be through creating these multiple revenue streams that as much as you can.
I think one of the reasons budgeting, and then we can go on to the next thing, but one of the reasons I think budgeting, I hate actually the word budgeting, but budgeting is in our control. I think that's why people tend to go to it first. So is earning another revenue stream, which what I think is even more important too than is the risk diversification. So, we've had uncertainty, and if one income stream shuts down, there's another one you can rely on. So I think it is really important, but it doesn't feel as in control as like what we spend our money on, because that's a choice we make every single day. And I also just want to be careful. I can feel someone listening who's a young person right now being like, what? I'm supposed to save 15 to 20% of my income? What? I'm supposed to save hundreds of thousands of dollars? What? I'm such a failure. So I just want to acknowledge that, no, you're not. I think that when you're young and you're starting out, it's really hard. And I think you just need to do what you can. And I think that all of these are amazing tips, but if you can't do every single one right in this moment, it's like a work in progress over time, and not to give up because you think that somehow you're not able to do all those things.
I'm so glad you brought that up, Shannon, because, as you said, there's so much information. Investing and wealth building is such a hot topic, right? So it's very easy to feel behind when you're hearing all of this information. So that's a great point. And I love how you're all talking about these building blocks and different ways to accomplish your goals, whether that be increasing your income, reducing debt, because it really does depend on people's personal situations. But what I do want to talk about is where people can look to for financial information and financial advice. Shannon, I think you mentioned briefly, there is more financial information and advice available than ever before, which is great because we have one of the most educated generations on investing,
Yeah.
which is amazing. But also that can get really saturated with advisors, robo-advisors, Reddit, YouTube, friends, family, all of the above. So how can a new investor figure out which sources are right for them?
I'm happy to jump in, and I think we are in a golden age of investment in financial content out there, because there's something for everyone. And I would just say to make sure that sort of that person is sort of qualified to be talking about it. I think that's like a number one red flag. What are their credentials? And number two, how are they paid? And so I'm not saying that every content creator who's got a sponsored post or something like that is evil and you shouldn't listen to them. I mean, people get sponsored. That's how the world works. But just making sure that if they're, are they selling a product or are they selling information? I think those are two different things. So if you're creating content that's like information overall and education, and it's sponsored, all good. But if it's consistently selling a product, or if there's any sort of get rich quick or take a high risk tolerance, I would say those are the red flags. So I think people really just need to pick who speaks to them, make sure they're qualified, and just watch for those sort of like red flags that's promising too much and too many product sales.
Yep. I agree with all that. I think credentials and registration matter a lot. Someone who should be ideally registered to give investment advice, that results in both oversight and accountability, which I think are really, really important in any profession. And you just don't get that with a random content creator. Not that there's anything wrong with a random content creator. Many of them do make great content. It doesn't mean that all unlicensed content creators are bad. But I do think you have to be really, really careful. So looking for credentials, top credentials like the CFP, the CFA, and registration with the securities regulator, if you're getting investment advice, are things that are really important to look for. And if somebody that you're following doesn't have those things, that doesn't mean that they're doing a bad job. I just think that what they're saying requires a little bit more scrutiny.
Yeah. I mean, everything's been spoken about so far, but the one thing I will just add to it is when you think about why the credential piece is so big is because any sort of content that an institution will put out, education content or advisors, they go through rigorous, like, vetting. There are layers of people who will vet the content, make sure it meets regulatory standards, and then put that content out. So it's tried and tested, and it's coming from a place where of professionals who've built this not only from their experience, but also from the years that they see around with working with different clients as well that they put out. When it comes to influencers, I think the one thing you've got to understand is, as Shannon mentioned, it's separating the product versus the information. And what influencers have done, though, is it's made topics feel really human and relatable, but they've also broken it down in a language that's less intimidating. It bridges it opens new doorways where people thought you could never do it, or we see ourselves in people who we decide to, like or subscribe to, and that allows that sort of gateway. But, there are real risks or red flags that you have to be careful of. We know the specific guarantees that you can get certain amount of money, or one size fits all kind of advice. So really being careful when someone is touting those, that it's just, use your intuition and really, parse through it as best as you can before acting on anything there.
One other thing I would say is looking for counter opinions. If someone does come with one size fits all advice or has a lot of conviction in something that they're telling their audience, looking at who is saying something different online. And I say this as someone who has tried to make content that sort of debunks some of the information that I see some content creators creating that I think is probably detrimental. So looking for counter opinions. Who is disagreeing with the person that you're following, and what are they saying, I think is an important part of consuming online content.
I'll just add one thing as well to what Ben said, also lifestyle flexing. This is a big way to lure investors in, showing those Lambos, big mansions, those luxury watches. This is like a marketing gimmick to get eyeballs attracted to what you're there to sell, essentially. So being really mindful of that, and that's really distracting from how they've actually earned that. Most of that is rented out, or it could be faked. So just being careful of that when you come across content like that.
I think those are great. And I just want to clarify some of, the acronyms. I think as people get more into personal finance and investing, they realize there's like a lot of acronyms that people have in titles. So two that I think Ben mentioned, CFA, CFP. CFA stands for Chartered Financial Analyst, and CFP, Certified Financial Planner. So those are just two of those credentials that you can look for. I know when I'm reporting stories, I always look for a person with credentials to make sure that I'm getting information that is reliable as well. So that's great. I would love to hear all of your thoughts as well on this, stigma that is real and exists around people feeling like they maybe don't have enough money or maybe enough knowledge to go to a professional advisor to ask for help. What do you think about that? What is there a threshold of when you should approach an advisor? Is there a right time to do it? I would love to hear your thoughts.
One of you, I keep jumping in first. I'm waiting for someone else to go first. I'll get in there. Don't worry.
I was looking at you, Shannon. I think
I was looking at you and Shannon too.
I'm delighted to go first.
You start.
I will. Okay. So thank you. I'm a fee-only financial planner. So for anyone who doesn't know what that means, it is a type of financial planning where you pay out of pocket for time, kind of like how you would pay a lawyer or something. So in my practice, we don't invest your money for you. We don't sell insurance products so that we're unbiased. I say this because when you're in the fee-only space, you don't you don't have a sort of minimum assets that you need to adhere to in order to give financial advice. If someone is able to pay for it, then you can see them. So one way for a young person who maybe doesn't have a certain amount of money as assets under management, that's a fancy way of saying how much money you have, enough money that will take you on as a client. And that can be 250,000, 500,000, a million, 2 million, whatever the sort of wealth management firm sets. So as a fee, you might want to look to a fee only, sometimes also called advice only, financial planning, where there aren't those investment management minimums that you have to have. So you could get that right out the gate. And it does cost money, but it also might be something like you do a sort of plan and then you don't see somebody professionally for 5 years. So if you were to amortize that out over 5 years, it sort of makes sense. And so that would be somewhere that I would say there is no minimum. There is no certain amount of money that you need to have in that, from that framework, from that context. You can get advice any old time. And I also think it's one of those things sometimes where, you know, how if people are, maybe they are feeling like they're not strong and they want to get strong and they're like, well, I'm going to get fit before I go to the gym, or I'm going to get fit before I go to my personal trainer. It's like, no, go now and go together. So I always think that getting financial advice is really important, and there are ways to do it now with professionals that don't necessarily need an assets like that. You have to have a certain amount of money before you can do that.
See, that's why you're the best person to answer that question. I think fee-only planners have been a great development in the Canadian market. They've become increasingly common and is a really nice option to have for people. PWL is one of the firms that manages assets for folks and does have a fairly high minimum. And I think fee-only planners are filling a really important gap that previously existed in the market. And it was previously filled by people selling high-fee products. And
Yes.
they were able to make money on small dollar amounts of investments because the products they were selling had such high fees. And so
Yeah.
fee-only planners have really filled that gap without requiring selling high-fee products. They're just selling advice.
This is definitely the realm of both, Ben and Shannon. Of course, I'm more from the DIY perspective, but what at least in my experience of what I've seen, even for someone who's starting out new, there are different layers now on different sort of advisory service of what Shannon alluded to, which is more like on a consultation basis. Set me on the right financial path, and then kind of, get the training wheels off, and then I can kind of take it on their own. So I think when it comes to someone who's starting out new or maybe wants to get a bit of guidance, it's probably worth having a conversation and getting sort of a direction of where you want to go based on your goals, your time horizon that you have, and what you're looking to do with a professional who can kind of structure your investment in a way that will last through the, I don't want to say the ages, but at least last through your whatever your goal is, whether that be retirement or home purchase, etc. So and you also see the cost structure coming down, and maybe, I don't know, Ben and Shannon, you can speak to it, but it's as it becomes more competitive, it's you have more entrants, and that just with more demand, you're going to see price compression happen. So it's not completely out of reach, but there's different solutions that are provided at different stages of people's life based on either assets or whether you just like that consultation approach there.
It's so interesting to talk about how things take a long time to change, but then they change very quickly, especially in investing, DIY investing. Things have changed a lot, even the last 5 years, of how people are seeking advice, paying for advice, and how they're investing. I mean, we all, most of us have a phone, and a lot of our investing is done directly with our, at our fingertips. So, how has the rise of mobile investing behavior driven by DIY investing, how has that changed investor behavior, and how can new investors take advantage of it?
So I will say, just to start, that there is some academic evidence suggesting that smartphones specifically, trading on a smartphone specifically, increases the purchase of riskier and lottery type assets. So that'd be things like options that can be very risky, or individual high risk stocks. They also tend to increase chasing past returns. So those are all really detrimental behaviors to investor outcomes, which isn't great. There's also evidence, which is not directly tied to phones, but probably related, suggesting that checking on your investments too frequently can lead to worse investor behavior. So I think the fact that we can access our investments and trading platforms on our phones it's really cool. Like, it's neat. I don't know if it's actually beneficial. I think it may be, if it's not managed properly or thought about properly, it may actually be detrimental in a lot of cases.
Yeah, and it's the way the direction of where the market is going. Accessibility is the big thing. You've broken with introduction of mobile applications, specifically trading applications on your mobile phone. You have now torn any barrier that used to exist, like 3-4 decades ago, where you had paper tickets and you had to call someone up and put a trade on. So it's so ubiquitous now. But it doesn't come without risks, as Ben mentioned. And I'm going to just add one more thing that we're seeing now, especially because Gen Z and millennials are obviously adopting it at a sort of a greater scale than sort of any other generation when it comes to investing. In fact, if you look at TD Direct Investing's sort of bulk of their trading platforms, a majority, over just slightly over 50% of trades are all done on the mobile application. But it's the one thing I wanted to point out is gamification, which is also adding to the mix of this. So in addition to having like push notifications, you have gamification where you have like confetti animations, or you have leaderboards or your streaks. You know, if you do a trade, you've hit like a five-day streak or something of this course. And this really gets you really saturated into that. It gets you engaged and more into it. And to Ben's point, this is where you have traders who are starting to make emotional decisions now, or trying to hit off, checkpoints, and also, speculative behavior. You're getting into more riskier investments in order to check those. But also, you're constantly checking your phone every 5 minutes. So sometimes the best thing is like just turning off those notifications, doing a monthly check-in, especially if you're a longer term investor, putting it away and then doing those check-ins at sporadically at like, 1, 2, 3 months, whatever the case may be.
I'll jump in and just one thing that I see come across. I agree with everything that's been said, 100%. And but often I still find that people are when there's that access, it's really hard not to take some advantage of some of those things. And there's been shockingly good gains, even by accident, over the last 5 to 7 years. And so I think a lot of people are confusing their good fortune with strategy and skill set. And I would say that for most people, what I think is a solid way around this, or a solid tip that I would give, is like having two portfolios. So like have one that's like, a well-balanced, low-fee, long-term invested portfolio, and then have another one that is for you to buy and sell what you want, what you're interested in, and what you think. And I always say, like, keep an amount of money that if it was to go to zero, if you're taking those kinds of risks, that your long-term financial security is not at risk here, because then it feels like you still get to participate in that part of what you're interested in, and what you might want to be experimenting with, but you're not doing it with your whole portfolio. You're not doing it with an amount of money that would be catastrophic if things didn't work out the way that you wanted them to. And because I am seeing a lot of that, my whole portfolio is in these two stocks, and it's like, oh, okay. So just, I think that it doesn't mean yes or no. It's not black and white. I think that you can just make sure it's a portion that you're enjoying and you're investing with, and then there's another portion that's maybe, and you can race them over 5 years and see what happens.
It's like a core and explorer strategy almost.
Yeah,
like you have a core
yeah,
portfolio, you anchor with something
like harm
else.
reduction. Exactly,
Yeah,
like a
yeah.
harm reduction portfolio. Like, it's just like, you're going to do this. That's great. Just make sure that you're doing it in a way that's safe.
Yeah. The one thing I also wanted to add as well, like to add to this, we talked about advisors and fees and things like this. We talked about the sensitivity of maybe, one of the things is that people don't feel like they have enough money to invest, or how do I need to be like, rich to invest to start with. And one of the biggest advents, that I guess not really spurred by mobile, but sort of to get to new investors, is fractional investing as well, where now you don't have to say that if you wanted to buy, let's say, Amazon stock, you don't need to have hundreds of dollars to buy an Amazon stock. You can buy a piece of Amazon stock based on where you are starting out at it. If it means it's $50, you can buy $50 worth of Amazon stock and you get a slice of it. So I think in that sense, that's really being driven, this sort of movement towards fractional trading is being driven by the fact that we have now mobile applications. But you also have, on the other flip side of that, not everyone has access to like a computer or a laptop or everything. So it does make it ubiquitous to get it to some of those rural communities where people don't have that easy access. And if you look at the world, like even a third, I'm going outside of North America. If you look at the developing world, you will find that there are more people who are more mobile users than have like a laptop at home or something like that. Essentially, this is your computer in the palm of your hand, or in your pocket, if you want to call it that.
I'm so glad you brought up fractional shares, Harry. And I think that that's a recent development that has made people feel like they can have more control over getting into the market. And something that you have all touched on, which I think is so important in starting investing, is diversification, right? We hear this word all the time. We know it's important, but what does diversification in a portfolio actually mean? And how can someone know if they are diversified?
I can start with that one. I think one thing to be aware of is that diversification is not the number of funds that you own. You could have a lot of funds and be undiversified, and you can also have a single fund and be extremely well diversified. Canada is actually a little bit of a unique market with the asset allocation ETFs that we've had develop over the last few years. Those are not super common products around the world, but we have a whole suite of them. An asset allocation ETF is a single ETF that you can purchase that gives you exposure to a globally diversified portfolio of low-cost index funds, including stocks and bonds, depending on what asset allocation you want to have. So that's really cool, and it only requires a single holding, and it's also really, really low maintenance. The thing that you want to avoid doing is investing in things that expose you to the risks of a specific thing, the outcome of a specific thing. So that could be one stock, where the outcome of that single stock, which can be affected by so many random things, is going to affect you. Similarly, though, for investment themes, like AI is a big one that people might be interested in right now, or a single industry. Investing in any of those things exposes you to something called the specific risk of that industry. And I'm going to get a little bit jargony here for a second. I apologize, but those are called unpriced risks, which just means that they're risks that you take that don't have an associated positive expected return. I'm sorry, that was jargony. Basically, they're risks that you don't want to take. They're random risks. They're a lot more like gambling than investing. So I would really be thinking about diversification from the perspective of minimizing those random risks, those unpriced risks, as much as possible.
Can I jump in? How I would describe diversification is like not all your eggs in one basket. So that could be there's a split between asset classes, which is like a jargony way of saying like bonds and stocks. And then there's a split further within stocks, like Canadian stocks, US stocks, international stocks. And then there's another layer of diversification, which could be like, well, that's all stocks and bonds. What about real estate or gold? Getting a lot of questions about gold and those commodities. And then that's all the places that your money can go. And you don't want to be pigeonholed in one specific place too much, because that means you're not like diversified and you've got all your eggs in that one basket. So that is how I would describe what diversification is if you're a new investor. Not all your eggs in one investment basket.
Yeah. I'll just add to it. I think this is one that we hear often, is that this saying, diversification is the only free lunch in investing. This is obviously spoken by Nobel laureate Harry Markowitz, and it rings so true to these days. I wanted to just mention a couple of things, because you've seen, if you think about, like, with the rise of social investing and democratization, you have forums like Wall Street Bets on Reddit, and you have these YOLO names that are being dropped, or companies that maybe even just going to the meme stocks and going to the other side of it, where we're chasing these returns. And it's full of risk. But even if you have conviction in certain companies, like I'll take you back in the day, think about Enron, Nortel, Lehman Brothers. These were companies that were regarded as sure things, and they all went to zero, essentially. So what diversification does, no matter how much you have a conviction, is even just making sure that you are creating certain thresholds on how much you invest in those sort of convictions that you might have. Whether that says, if I have a strong conviction, for example, in Amazon, even though it's great, it's the best earnings growth company, I'm going to only allocate 10% of my portfolio. You'll see a lot of prudent portfolio managers, even who construct these products like ETFs. They build these based on basing on those thresholds. But the easiest way to do it, and now that we've said it, like Ben said, you have single stock ETFs, or single asset solution ETFs, I should say, or one-click portfolio solutions, where you get everything. You get a piece of the equity space, the fixed income. You get alternative assets, maybe perhaps, which includes real estate, a bit of gold sprinkled in there. But it's just the allocation to spread risk at the end of the day. That's what you want to do. You want to be able to essentially have the umbrella and the sunscreen for if it's too hot or if it gets rainy there. And that's what diversification is for me.
That's great. That's great. And, as we said, there's a lot of, acronyms in personal finance. ETF, for example, exchange traded fund, as Ben said, it's basically just a bundle of stocks, bonds, or other assets that you can hold by holding one ETF, exchange traded fund. So I want to uh, go into some other acronyms that are sometimes confusing for a lot of people who are starting investing. So let's say people have this diversification down. They know what they can think about with their risk tolerance, but then they're presented with tax-free savings account, TFSA, RRSP, registered retirement savings plan, FHSA, first home savings account. How can people think about which one is right for me? Where should I start? Option paralysis. Where is a good starting place for someone who doesn't know where to start?
Jump in on this. Um, I have an analogy that seems to land where if we think about the TFSA stands for tax-free savings account, the RRSP is registered retirement savings plan, the FHSA is the first home savings account. So they all have these acronyms for these big words. But I often think of all the investment accounts that you can have like a house, right? And so if they're a tax shelter, they've got a good shelter, they've got a good roof on them. And how you invest is sort of how you decorate inside. So my TFSA is going to be decorated differently than your TFSA because I have different taste in my investments, which is my risk tolerance or my time horizon and the things that make me like where I want to be invested. And you can always redecorate. So just because something is your investment right now inside the TFSA doesn't mean you can't switch it up as you get older and as you move on. And so if we think about that, then we're really that's sort of like how I think about them just as an account. And the second layer of, okay, well, understanding what these different accounts can do for you is sort of the next layer of that. So what are they and what can they do for me? And then how do I invest? So I hear a lot of people say like, well, can I have an RRSP inside my investments? Or like, can I I have a GIC RRSP. And it's like, no, you've got a GIC inside your RRSP. Do you know what I mean? Like it's like a couch. And so I think that with the TFSA and the RRSP, and I'll let you other two kind of go through the next part, otherwise I'll end up talking too long. But that first layer of just understanding what they are and knowing if they're the major difference between a tax shelter and a tax deduction and how those work for you. But I will leave it over to my wonderful colleagues here to take it from there.
Ben, you want to jump in or can I?
You can go ahead and I'll go.
Right.
I'll go next.
Yeah. So I mean, exactly what Shannon mentioned. I think you've understanding the products, but also it is about when you think about at the end of the day, what is going to impact your returns as an investor. And there's usually two things. One is you have to be very conscious about fees. And the second is about taxes as well. So these accounts are really there to help you sort of, take advantage of like a TFSA, for example, is going to be completely tax-free on any growth that you have through that investment vehicle, of course, that you have. The RSP, of course, is a tax-deferred one where you are going to pay the taxes. The idea is to pay at retirement, hopefully being in a lower tax bracket than when you're kind of at the height of or peak of your career. So it's strategically thinking which accounts are going to be used at what for what purposes, but also being able to see how can I reduce some of the tax implications that are going to be there when it comes to using these accounts. But the other part of that is also there's certain limits to how much you can put in there. So if you have excess amount to invest in, maybe you're going to tap out of a TFSA or you have certain room to use an RSP, then you might need to turn to other accounts. But it's also the goals and the flexibility that you have. Like a TFSA allows you to withdraw the money, and if you need it for anything on an emergency or in a pinch, you can do that. Whereas an RSP won't allow you to do that. So you also have to think about the flexibility that you'd want with your investments, and if you need it for maybe on a short to medium term, what's going to be sort of the more efficient vehicle to use.
Yeah, I think you guys hit the nail on the head across the board. I like the house analogy. I've used a shopping bag analogy, which is pretty similar. The account types are just different bags, but you have to put your groceries inside of them. Same kind of idea. And then I think for which account to use, so we understand they're like shopping bags. You're going to put whatever investments you buy inside of them. It's really got to line up with your goals. So with the FHSA, for example, it becomes a fairly obvious use case if you're planning on purchasing a home. The RRSP does also have the home buyers plan, which can be quite interesting for a home purchase as well. And then thinking about the RRSP versus the TFSA for long-term investments, Hiren talked about this, but I think a really interesting little, thought experiment, I guess. is when you think about the long-term value of the RRSP relative to the TFSA, if you make the assumption that your tax rate is going to stay the same at the time that you contribute and the time that you withdraw from the RRSP account, the after-tax outcome between the RRSP and the TFSA is going to be the same. Now, most people, as Hiran mentioned, would expect to have a lower tax rate in retirement than they have during their working years. But you've got to think critically about where you're at today, where your income is at today, and where you expect it to be from a taxable perspective in the future. If you have a particularly low income year, that may not be a good year to make an RSP contribution and use the RSP deduction. So you might use the TFSA. If you have a particularly high income year, the RSP might make a lot more sense. So I think that type of thinking, that type of long-term planning, in addition to the other comments that Hiran made about which accounts to use, is a really important piece of that thought process.
And I think it really comes down to understanding how each one of these accounts works so that you can make those really informed decisions, and understanding that it's not a set and forget. Like maybe it used to be, but we have lots of options now. And each year, as we get more and more uncertain and the world changes and our incomes change and shift up and down, I think, you kind of approach every year with like, what's good for this year and does this still make sense? And being open to pivoting. I think that's a really important point.
Thank you to you all for mentioning all of these really important things that people can do, take away, learn on their own, and also questions to gut check themselves. I think a lot of what comes from this is, reflecting on what your own wants, needs, goals are, because your financial plan is going to look completely different from your best friend, your sister, your parents. So I think these are all great tips. Speaking of what has been different maybe for people starting today than maybe their parents, definitely their parents and their grandparents, is AI. We have AI tools that can help us understand, complex jargon. They even can help build portfolios, analyze markets, and learn just more about finance. So, where do you see AI being genuinely useful for investors, and where should people be cautious when using this tool?
I can start. I'm using AI a lot for research, for the writing that I do. We're also, as a firm, PWL is trying to figure out the best way to use it systematically in our business. Now, I don't want to sound like a Luddite. I know there's a ton of hype around AI right now, which is fine, and a lot of it is warranted. But one of the issues that we continue to have when we're thinking about how to use this as a business is that there's persistent inaccurate information and hallucinations. And that's something that has maybe gotten a little bit better over time, but it's still, especially when you get into technical financial planning and investing information, it's still there. It does not seem to be going away. Now, as professionals, like for me, for example, or other folks that work at PWL, we can often catch those errors and notice, oh, hey, this piece is wrong. Or maybe we go and ask one of our colleagues, hey, the AI said this. Is that right? But if someone is a non-expert who's consuming that information without that type of scrutiny, I do worry quite a bit about how it could lead to people to make suboptimal decisions with just incorrect information. So I do think it is very useful. You can ask it questions that are specific to your situation. You can ask it pretty technical questions, and it will give you an answer. But I do still worry, even today, as much as the models have gotten better, I do still worry about accuracy and hallucinations, particularly when we get into more niche and technical information.
I think that, like, similar to Ben, I think that the risk of inaccurate information is there, but I also think that one of the things, like, I often have made the joke that my job as a financial planner is like 90% life coaching and an EQ and 10% a spreadsheet. So, like, hey, if AI can do the spreadsheet part, like, cool. That's not what people have been paying me for 20 years. I think that there's something about being a trusted person. Two people are fighting about money because they can't decide on a trajectory. AI can have a conversation with you about that, but at the end of the day, it's not necessarily going to be the same as someone who can help navigate that, or at least I don't believe that it will be, that EQ piece will be fully replaceable. And as it gets more and more complicated and comprehensive, I think that need and requirement for a human will still exist in the financial planning realm anyways, which is where I dwell. So I think it can be helpful because I think it can help to maybe in those initial layers, like for example, let's say someone is filling out homework for me for a financial session and they want to analyze their spending over 3 months, something that might have taken them 5 hours on a Saturday with a lot of tears and frustration now might take them like 45 minutes and dumping some spreadsheets into AI chat. So I think that it can help with people sort of being more aware of where they're at with their finances. I personally hope and believe that I don't think it will ever fully replace like the need to work with that human connection piece, especially when it comes to comprehensive financial planning, because there is such a complex, custom human element to that part of wealth management.
Yeah, and I'll just add like just a few thoughts to what Shannon mentioned was like, AI doesn't know your full life situation, and to her point, right? It doesn't have that EQ intelligence that you'd want. It's based on what you prompt it. So the more information you feed it, the more you're hoping, the more accurate it will get. But again, to Ben's point, it is prone to having hallucinations. It is prone to biases as well, because at the end of the day, this is a complete data set. It's built on data, and it's an amalgamation of that data that's going to give you this information. So where I do think that you do have to be cautious is, how you use the prompts. What is the nature of how you're using it for AI? Like in our business, we certainly use it for research purposes. It's compressed that sort of creative time way down when what it used to be. But it also helps us. Ben made a point earlier on, when you're making decisions, you want to be critical and get the opinion of the other side of that. If someone is promoting something, AI is a great place to do that, and some summation and give you a summation of that. If someone's promoting a stock recommendation, maybe you go and ask it, what are some of the risks, or what are the weaknesses in this business or this company, and it will present that to you in a very succinct and quick manner. So I think it's really there to help you aid your decision-making process, but you don't want to get complacent where you're relying on it too much, where you have automation bias now as well, where you're now disengaging your own critical thinking and you're completely reliant on AI to kind of make those decisions for you. So that's where the fine line is. Use this as a tool to help you aid your decisions, help you become literate, financially literate, investing literate. You can ask it simple things like, when Ben said, I don't know what he said, the risk price thing, I could just say, explain risk price to me like a 5-year-old. And I'm sure AI could do that for us, right? So that's kind of the power that it does hold. But you also want to be careful that you don't give it too much power where you let it think for you now as well.
An analogy that I use sometimes when I'm describing it, do you know, like if you're in an Uber or something and it takes the silliest route because it's the most basic route, and you're like, well, actually, if you just go down this route, this route, this route, you're there faster without traffic. It's very similar. So like, yeah, you could get there, but you might be getting there slower and sitting in traffic and annoying because the bot sent you this specific way. But if you actually have the knowledge and the strategy, you can circumvent it faster, more efficiently, and with less of a painful drive. And I think finances will be like that too. So it can get you to a basic level, but if you actually want to do it efficiently for yourself in that custom way, it's going to come down to strategy.
Yeah,
Thank you.
I do have just a couple more thoughts. One other concern that I have with a lot of these models is that they will tell you what you want to hear.
Yeah.
Which I think can be really problematic when it comes to to financial decision making. Someone shared with me one example where someone had asked one of the LLMs about one of my videos and said, basically, tell me why Ben Felix is wrong in this video. And it spat out a bunch of points that were very easy to disprove, like there was objectively incorrect information, but it supported the sort of a counter position to what I had said in the video. And this person had taken that and thought, okay, Ben Felix is definitely wrong, just as I suspected. But I think that's really dangerous, where it really will confirm whatever you want to believe. It'll be very quick to correct itself. If you say, well, actually, that point is wrong, here's why. It'll, say, oh, you're so right. Sorry. So I think that's problematic. I do agree completely with what Shannon said about it not being in a position yet to replace trust, which is a huge part of what financial professionals are able to provide to people. Like when people come to PWL, they do come for investment management and financial planning, but they really come for trust. They want to have a relationship with someone who they know and trust, who understands them and their financial situation, to give them guidance on what they do and what decisions they should make and how they should approach those decisions. I would be very surprised if any of these models are able to displace that portion of what financial professionals do anytime soon.
That's such a great point. I did this story last year on financial planners that were actually getting additional certifications to help them with this kind of, life coaching aspect of their work, like grief counseling, things like that, because it is such a massive part of their job. So this has been great. I want to make sure we get some time in for some of the awesome questions that we've got from our audience. Before we dive into these questions, I just want to tell everyone to please take a moment to check your inbox. We will be sending out a survey regarding this discussion, and it would be great if you could all take a minute to complete that. So let's just get into some of these questions from the audience. We have one question that came in that I thought was really interesting. Would love to hear your thoughts on alternative assets and investments. So that can look like crypto, fine art, collectible items. What are your thoughts on having that in a full financial plan or portfolio?
I will quickly say all good as long as it's a small enough percentage. In the same way that I said before, it can be a nice hedge and another form of diversification.
Yeah, I have nothing more to add than what Shannon said. I think you obviously at the end of the day, you have to understand when we talked about sort of that core and explore strategy. So if you still anchor your investments in kind of the bulk of your core investments, and if you wanted to dabble in crypto or alternative assets, whatever that case may be, gold or those other things, then you just allocate according to your risk tolerance, just a smaller portion of it where, at the end of the day, if you end up losing that, because if they are going to be of higher risk nature, then you're still going to be able to sleep, and you're not gonna wake up in a cold sweat or hot sweat in the middle of the night with the allocation that you have. So it's really about the sizing, essentially, how much position sizing you have according to your risk tolerance. Fair to do. I think BlackRock, if I'm not mistaken, they'd in fact recommended as part of their balanced portfolio. They said like a 2% of their overall portfolio allocation should be towards like crypto investing, as an example, to the sort of their investor group. But it's up to you how much you want to do, but just do it within a parameter that fits your risk.
I have been and continue to be pretty skeptical of most alternative investments, and I really don't think that they're necessary for most people to meet their financial goals. And in a lot of cases, they're going to come with high carrying costs and a lot of excess risk, and the types of risk that most investors probably should not be taking. So if you look at the asset allocation ETFs that most of the financial companies in Canada have produced, they own a huge cross section of all the stocks and bonds that exist in the world. I really don't think most people need more than that to have a really well diversified long-term portfolio. You start adding in stuff like crypto, collectibles, fine art, private assets, all that kind of stuff. I think it unnecessarily overcomplicates things, and I don't think it materially improves the expected outcome. And in a lot of cases, I think it probably makes it a little bit worse, and in some cases, a lot worse.
Right. Well, a lot of our advice today as well, I've been saying a lot of it's for young Canadians, young people, but a lot of this advice could be for anybody at any age who is investing. So we do have a question here from someone who's watching saying, do you have any advice for someone who wasn't financially literate and didn't start investing until they were middle-aged?
I would say the same advice as somebody that is just starting out, but what you need to be aware of is your time horizon might be different than somebody who's 25 versus, maybe 50. That whole idea of when will you stop working and turn that income tap off, that's a different timeline and a different trajectory. So maybe your exposure, your willingness to have volatility, which is like, stock markets up and down, super normal. You might have a different ability to withstand that than somebody who's just starting out. But the advice as far as understanding sort of what those different accounts are, how they work, which one is right for you and when, that all holds no matter what. The advice that's been talked about today about like making sure that you've got a plan to manage high interest rate consumer debt, that you've got an emergency account, like that all stands no matter who you are and where you're at in your life. I would just say the types of investments and the risk tolerance, and that's just a jargony way of saying like how much in investing, sometimes if you expose yourself to a little bit more volatility, it's possible that there's greater potential growth, like your investments will go up by more. But it depends on how long you have until you need that money. So that would be the big red flag that I would give. But otherwise, I think that a lot of the advice we've talked about here is the same, no matter where you are in your journey.
Yeah, I would say like it's it's never too late to start. Despite that you think that you might have had like you're behind the race. We've in our education platform we run a podcast show every Thursday, and we have a guest that comes on, and I don't think he started till his like late 50s, and he's been continuing that through investing, and he came from a background where he did not invest at all. So the important thing is again to get started, get in there. At the same time, but you're also not only are you investing in your obviously your money, but you're investing in yourself by doing that because you also want to, you mentioned that you're not financially literate, but obviously it sounds like it's in the past tense, which means you've done something for yourself, which is now making you more financially literate. So when it comes to money, for something that's so emotionally connected, it's always good to get it invested, but also to improve your own financial literacy so you know what's happening with it. And there's no time like today then if you're kind of on the sidelines with that.
I agree with everything that you guys said. I've had a few people. I've got a podcast that has 400 some odd episodes out. I think we're about to release our 400th episode this week, and I've had people tell me that they went back and listened from the beginning, 400 episodes, which to me is crazy. Like they weren't listeners from the beginning, but last year they went and listened to all 400 episodes. Like, man, that's wild. But I've had so many people tell me that doing that completely changed their life. And I'm not saying it has to be my podcast, but finding a resource that resonates with you, that you can sit down and really listen to and consume high quality financial information, from what I've been told, can have a very, very meaningful impact on the trajectory of your life financially and otherwise. So again, I'm not saying it has to be my podcast, but finding some source of information that you're really comfortable with and that resonates with you, and consuming that to the point where you feel confident in your finances, I think can be something that's very, very valuable for somebody at any age.
I think that's so important. What I found even personally is talking about money with my friends and family too. Like making this a normalized conversation. Talking about money is so taboo in a lot of spaces. So the more the more you can talk about it with family and friends, it can feel like, an information exchange, and you can feel not so lonely because it can feel pretty lonely thinking about your own money situation. So I think that's great. We're coming up on time here, but before we wrapped up, I wanted to ask each of you, one last question. And what I really want to know is if you could go back to the beginning of your investing journey, if you can, place yourself in those shoes, what's something you would tell yourself? What's a piece of advice you would give yourself?
I'll start, I guess. I started out before I was educated in finance. I started out investing in high fee actively managed mutual funds because I had my first couple of jobs, and I went to the bank and told the financial advisor there that I had some money, and it took me a while before I went and studied finance and then started working in this field. It took me a while to understand that that's probably not the best way for most people to invest. So if I could go back and start over, that's one of the things that I would do differently. It was a little bit different back then too. Today, the ease of access to low cost index funds it's incredible. Like we really are living in a golden age. I think you said that earlier, Shannon. But yeah, I didn't know that until, I don't know, 6 years into my working life. So that would be a big one.
Yeah, no, I think for me it was just the fact that you just starting early enough. I think I was kind of late to the game, and then I always felt like I needed to play catch up, and just having sort of my conviction portfolio is built around like 5 or 6 names, kind of thing. So getting early enough invested, of course, is a big part of it. And, the dynamics have changed. Back in the day, you had to have certain thresholds and funds to be able to invest, and now you don't even have that anymore. So that barrier is removed. But even just making sure that diversification, because when you're starting out young, as we've mentioned, like you're looking to chase those, getting extra alpha, which is mean you want those higher returns than what everyone else is getting, and you're going to get into more riskier, tend to make riskier bets. But really just focusing on building a core, diverse, anchored portfolio, and then being able to kind of dabble in some of those other things, which is kind of something that I would obviously do differently if I could go back in time there.
I have two. One's funny. I inherited like a few $1,000s of Nortel stock when I was 16, and I wish I had been paying attention. But that went to zero. But for real, I was working on Bay Street during the 2008 crash, and I was only 22, and experiencing that for clients and for myself. And my boss at the time was like, I got a bonus, and she was like, invest it. And I was like, are you crazy? Everything is tanking. And she's like, invest it. So I only did half because I was so scared, which at the time was a good decision. But like, man, I wish I had just been like, I'm young, and like this really educated portfolio manager who has their CFA is like, do not be afraid, child, let's go. And I wish I had just listened to her because everything would have, everything bounced back afterwards, and I could see that it was like a lot of my panic was just inexperience and a lack of fully understanding market cycles, and I just didn't have the investor knowledge that I have now and the wisdom to breathe through it. So yeah, I wish that I could go back in time and just fully listen to her. If she's listening right now, you know who you are.
Great note to end it on. I really appreciate it. We will have to leave it there. So on behalf of the Globe and Mail, I would like to thank Karine, Ben, Shannon. Thank you so much for being here today, sharing all your wisdom. It has been, I know it's been helpful for me, so I think it's been very helpful for our audience. We also really want to thank our sponsor, TD Bank, for making today's event possible. And of course, big thank you to everyone in the audience for tuning in. We are going to put a QR code on the screen. It would be awesome if you could complete our survey, which is what this QR code will lead you to. And also a link to this webcast will be sent to all registered participants within the next 2 weeks, so you can watch it over and over again. So thank you again to all of our panelists, to our audience members, and we hope you have a great rest of your day.